September 2008. In Lower Manhattan, inside the towering buildings of Wall Street, something felt very wrong. Trading floors that were usually loud and chaotic suddenly felt tense and quiet. Phones were ringing constantly, executives were whispering in closed conference rooms, and traders were staring at their computer screens in disbelief. Every second, billions of dollars were disappearing. Stocks were crashing, credit markets were freezing, and the world's most powerful financial institutions were starting to panic. For decades, people believed the global financial system was nearly indestructible. Banks were supposed to be stable, markets were supposed to recover, and governments were supposed to prevent disasters. But on this day, the entire system was dangerously close to collapsing. The institutions trusted with trillions of dollars, the banks responsible for funding businesses, the markets that powered the global economy, all of it was on the edge of failure. And it all centered around one street, Wall Street. This is the story of the day Wall Street almost collapsed.
To understand how the financial system nearly collapsed, we need to go back a few years before the crisis. In the early 2000s, the United States was experiencing one of the biggest housing booms in history. Home prices were rising rapidly, neighborhoods were expanding, construction companies were building houses everywhere. Owning a home had become the ultimate American dream. Banks were eager to help people achieve that dream. Mortgage loans became easier and easier to obtain. People who once would have been rejected for loans were suddenly being approved, even individuals with poor credit histories. These loans became known as subprime mortgages. Subprime borrowers often had low income, unstable employment, poor credit scores. Traditionally, banks avoided lending to these borrowers because the risk of default was high.
But something had changed. Banks were no longer worried about risk because they had discovered a new way to make money for mortgages. Instead of keeping the loans on their balance sheets, they bundled thousands of mortgages together and transformed them into financial products. These products were called mortgage-backed securities. Investors from around the world bought these securities. Pension funds, insurance companies, hedge funds, foreign banks. Everyone wanted a piece of the booming American housing market. Major investment banks such as Lehman Brothers, Bear Stearns, and Goldman Sachs were deeply involved in creating and selling these products. At first, it seemed like a perfect system. Banks made money issuing loans, investors made money buying securities, and homeowners got access to mortgages they previously couldn't obtain. But beneath the surface, a dangerous financial bubble was forming.
Wall Street believed it had solved the problem of risk. Through complex financial engineering, banks created new products that were supposed to make investments safer. One of the most popular products was the collateralized debt obligation, or CDO. CDOs bundled together thousands of mortgages and divided them into layers called tranches. Some tranches were considered safe, others were considered risky. But here was the shocking part. Credit rating agencies often labeled these securities with the highest possible rating, AAA, the same rating given to U.S. government bonds. This meant that investors around the world believed these securities were extremely safe. Banks sold trillions of dollars worth of these products, and the profits were enormous. Bonuses on Wall Street reached record highs. Executives made millions, traders made fortunes. No one wanted to slow down the machine. But there was one massive flaw in the system. Everything depended on one assumption, that housing prices would never fall nationwide. Unfortunately, that assumption was about to collapse.
Around 2006, the housing market began to weaken. Home prices stopped rising. Then they started falling. For homeowners with stable income, this wasn't a huge problem. But for subprime borrowers, it was devastating. Many of these borrowers had adjustable rate mortgages. Their monthly payments suddenly increased dramatically. Some payments doubled, others tripled. Millions of homeowners could no longer afford their mortgages. Foreclosures began rising rapidly. As more homes were foreclosed, housing supply increased, and that pushed prices down even further. Soon, mortgage-backed securities began losing value. Investors who had purchased these supposedly safe securities were now facing enormous losses. Banks began realizing that the financial products they had created were far riskier than they believed, and the panic started to spread. When Lehman Brothers collapsed, fear spread across the global financial system. Banks stopped trusting each other. Lending between financial institutions froze. Credit markets began shutting down. Stock markets around the world started crashing. Investors panicked. Companies struggled to access loans. Even healthy banks began facing serious problems. One of the biggest threats emerged from the insurance giant AIG. AIG had sold billions of dollars in insurance contracts tied to mortgage-backed securities. When those securities collapsed, AIG suddenly owed enormous payments. Without government intervention, AIG would have failed. And if AIG failed, it could trigger a chain reaction that would destroy the entire financial system. Faced with the possibility of total economic collapse, U.S. officials took drastic action. The Federal Reserve and the U.S. Treasury Department launched emergency rescue programs. The government injected hundreds of billions of dollars into banks. This bailout program became known as the Troubled Asset Relief Program. Its goal was simple: stabilize the financial system before it completely collapsed. Some banks were forced to accept government funds. Others desperately needed the rescue. The move was controversial. Many Americans were angry that banks were being saved, while ordinary people were losing their homes. But policymakers feared that without intervention, the consequences would be catastrophic. If the financial system had fully collapsed, the consequences would have been devastating. Banks would stop lending money. Businesses would be unable to pay employees. Millions more people would lose their jobs. Retirement savings would disappear, and global trade could grind to a halt. Economists warned that the world could face another Great Depression. The collapse of Wall Street would not only affect the United States, it would impact every country connected to the global economy, which means nearly every country in the world. Eventually, the emergency measures began to stabilize markets. Banks slowly regained confidence, credit markets reopened, and the financial system survived. But the damage was enormous. Millions of Americans lost their homes, unemployment surged, entire industries struggled to recover. The crisis triggered the worst economic downturn since the Great Depression, and it forced governments around the world to rethink financial regulation. New laws were introduced. Banks were required to hold more capital. Risky practices were restricted. But the memory of the crisis remains a powerful reminder. Even the most advanced financial systems are not immune to collapse. The events of 2008 revealed something shocking. The global financial system was far more fragile than anyone imagined. A housing bubble, risky loans, complex financial products, and excessive leverage created the perfect storm. For a brief moment in history, the world came dangerously close to witnessing the collapse of Wall Street. And if that collapse had happened, the consequences would have changed the global economy for generations. The question now is not just what happened in 2008. The real question is this: could it happen again? Because if history has taught us anything, it's that financial crises often repeat themselves, and somewhere in the markets today, the next crisis may already be forming.